Evening, everyone. My name is Javed Jussa, and I'll be hosting the final panel on quantitative investing. I know we are the last panel before the drinks, and this could maybe lead to what we call in the quant world investor inattention. And it is an alpha signal, so please listen in. I wanted to start about talking or discussing about quantitative performance. From hearing clients, I've seen that performance of quant strategies has been mixed year to date. Some of the multi-managers who maybe focus on more nonlinear quant strategies or alpha have had reasonably good performance. Some of the risk premia strategies have experienced reasonably good performance, reasonably strong performance. However, some of the more traditional ML factor strategies, which are risk controlled, have had challenging performance. And I wanted to sort of start off the panel to discuss performance, and maybe I'll start off with Shafiq, who leads systematic strategies at CPP. And just to start off by saying, what are you observing in terms of performance, in terms of ML strategies, or in terms of traditional risk premia strategies? What are you seeing out there?
Sure. Thank you, Javed. So I lead the quantitative equity team at CPP Investments. We're part of the systematic strategies group, and we manage a number of equity, long, short, and long-only strategies. CPP Investments is the largest pension fund manager in Canada. And so it's certainly been a really great year in terms of quant equity performance. And the traditional risk premia have done very well. We've seen strength coming in momentum. We've also seen value doing well, which is sometimes unusual to see both value and momentum doing well, quality. And it's been true across the globe. So in Japan, for example, value has been very strong on the back of some corporate governance reforms. Momentum's also been doing quite well. And I think part of the driving force for that is that the macro environment has been relatively benign and consistent. And so we've had strong growth, pretty low unemployment, inflation is generally coming down, and we have a lot of themes that have been driving investing. So AI is certainly a big one. There's a lot of talk about the Magnificent Seven, and all of that makes for, an opportunity for these traditional risk premia to do well. And that's what we've seen. For pure alpha strategies or machine learning strategies to sort of capture some of that, I think what needs to happen is they should be able to focus on alternative data sets that can capture those macro themes, those macro trends. And so whether that's looking at labor markets or earnings growth or sales growth, if they are able to do that, I think they can sort of capture that risk-on behavior. And another area would be if these machine learning strategies can sort of identify the traditional risk premia that are going to do well in the macro environment and make those appropriate switches, then that's another way for them to achieve good performance. So, which is challenging.
Yeah, thanks. So you think the use of alternative data or maybe more targeted style timing as a result of the macro environment may enhance traditional ML strategies?
Correct. Yeah, that's right.
Yeah. Arik, what are you sort of seeing out there as well? Some of our clients are complaining about performance, especially due to sort of the short interest factor rallying when you see a sudden risk rally. So they're exposed to short interest, negatively exposed to short interest. There is alpha there, but a lot of times they get stung when when there's a risk rally and short interest rallies. What are you sort of seeing in terms of performance? I know you've built some synthetic hedge fund return type strategies, so I'd be interested to hear your views on performance, recent performance, and how potentially ML strategies can enhance performance.
I would say that the issue of crowding, and by crowding I mean commonality in the action of investors, meaning they trade for the same reason at the same time. This is something that becomes more and more of a risk and explain some of the gyration we've seen in recent years or over time as opposed to 20, 30, 40 years ago. And in part, this is much more of a risk when it comes to systematic investing, because systematic investing being driven by investment rules is much more prone to the ability of investors using, broadly speaking, the same signals, and we just heard a few, momentum, value, and so on. They may be slightly different in the way they're being specified, but broadly they're similar, and therefore they would result in investor trading similar security at the same time, going in and out. And that's what creates the crowding effect, which tends to exacerbate market movements, which we've seen over the last decade and prior to that. So that's one aspect. Short interest is one element of this, and kind of can be used as one indicator. And at the same time, we've seen some changes in the use of short interest and the whole notion of shorting as an outcome of the dynamics we've seen around GameStop. So I think the GameStop episode and some other stocks certainly highlighted the risk of a short squeeze. Certainly highlighted the fact that short squeezes can be a result of different type of action from different groups of investors that maybe weren't seen as such beforehand. So on one hand, given that there is increased risk in shorting, that may deter some from doing it, and at the same time, those that have high conviction would be doing it. So in that sense, looking at short as conveying some information about the fundamental views of investors is now stronger than before, because those who actually do that have more conviction than before, given the increased risk that they see in those actions. So certainly it's something that we follow, we use. By the way, not only in equity market, but also in credit markets. There's shorting activity there, and there is predictability in shorting equities that it pertains to the bonds issued by the same firm. So those views tend to be informative beyond the securities they apply to, but more broadly to the capital structure of the firm. So certainly that's something that we see, we use, and we see investors employ in their investment process.
Right. No, yeah, thanks for your insight. I also feel crowding is an interesting, if you want to call it a risk factor. It's hard to measure. You can look at 13Fs, you can look at hedge fund holdings, retail positioning, but often hard to quantify without a true measure of everyone's position or without positioning data. So yeah, it's an interesting point to bring up. And I wanted to ask you about performance. I know you mostly deal with sort of futures type strategies. What are you noticing in terms of performance on the strategies that you delve in?
I think it's, to go back to your point about defensiveness of certain futures-based strategies, I think this year is a case in point. It's been weak, and it's been a roller coaster. So trend following, for instance, which always has some sort of defensive component, has been suffering. It had a great Q1, and then it has been subject to reversals and actually very sharp drawdowns during the year. On the other hand, what I should say is that people who manage portfolios, diversified portfolios of which this is only one part, know exactly what to expect and know what they have in the rest of their portfolio. So very often, they don't have just a very narrow view on the performance of these strategies. They know how their fixed income book is doing, how their equity book is doing, et cetera, et cetera. So if they are disappointed, let's say, by the performance this year in certain parts of those alternative strategies, they will know that their equity book is doing fabulously well. And they would also know that in another year, maybe when both fixed income and equities go down, like it was the case in 2022, the alternative strategy will fill that particular bucket and will provide that diversification. So I think it's very important to keep all these things in perspective and to look at the portfolio on a very broad basis.
Yes, no, interesting point, and thanks for your insight. I wanted to discuss something you mentioned about risk. and how it's associated and relative to our traditional risk premia strategies. So one of the issues with your risk premia strategies is more like tail risk or correlation in the tails, where we may see value and quality negatively correlated in a typical environment. However, when there's a shock to the market or shock to the system, we notice that the correlation will increase on something that initially appeared negatively correlated. And I want to get a sense of how you sort of deal with that, maybe measure that, and how do you sort of address that for periods of market shock. And maybe Samira, you could walk us through some of your thoughts and insight.
So when it comes to these tail correlations and as a matter of fact, to any surprises, we should see like how sudden they are unfolding. Is it really sudden, or the information is already out there and we are not capturing those? There is a recent paper from Cliff Asmussen published in August talking about markets becoming less efficient in the past 30 years, which the implication will be we're going to have these shocks even unfold more gradually. So at the end of the day, who has built better systems that capture those shocks quicker than others, and they can detect the source of those shocks and take the proper action on those, like de-risking of the portfolio, whether they want to like stay the course or take the other side of the bet, or tilt to other idiosyncratic factors that are less impacted by the shocks. Those are going to be the winning strategy. From the risk model perspective, most of these models are not able to capture all the factors, and they are really calibrated on the history when it comes to the tail correlations. There are not enough data points. And even the current system, they are usually calibrated on fundamental shocks. So when it comes to liquidity crisis, like the quant event of 2007, when some of these pharma-French factors, they had really tail correlation. Those cases are like very extreme for the risk system. There was I think in 2007, in 4 days, there was 25% drawdown in volatility and momentum factor. That's 30 standard deviation event per year. So for us as a pension plan, we look at these style factors as another layer of diversification and to broader diversified portfolio. Like you mentioned, we have diversified across geographies, asset classes, private, public assets. So if there is going to be a day that these style factors are not going to perform and they're going to be positively correlated in their tail end, we accept those sort of negative impact, and we hope that there is enough resilience in rest of the portfolio to cushion the blow. For some of the fundamental factors, we have in-house systems built that they are able to shock these fundamental factors to the extremes. They are built to basically model the time-varying correlation among the assets, so they can do really like extreme scenarios and provide us with more insights and colors where we are vulnerable and where we have to make the portfolio more resilient. Having said those, there are some research that they look into managing the co-skewness of these style factors for the tail. Those are, I think, promising, but I haven't personally looked into those yet.
Yeah, I've read some research on managing tail risk. You can do it the copula, or you can assume a different type of distribution at the tails. But as you said, it's limited data. It's not necessarily ingrained in the risk model, so you need a different type of distribution. Any other panelists want to chime in on how to manage tail risk or measure tail risk?
I think it also depends on how quickly the shock takes place, right? So if it's a more gradual shock, which perhaps you can use some kind of regime switching model, but if it happens instantaneously, it's really hard to predict that. And so in that case, as Samira mentioned, you just want to look back historically and see, what are the incidences of those tail risk behavior, and how comfortable do you feel with that kind of risk in your portfolio? And if you don't feel comfortable, then you should perhaps scale back on that risk. I think that's probably the best approach.
Yeah, I've seen some research where you sort of tighten the correlation calculation window to capture more recent correlation in the market, but it has other effects like leading to higher turnover, etc. So I think it's a difficult problem to solve. Mark, do you want to chime in?
Yeah, maybe a few thoughts, because it's a kind of a topic we're actually working on. So one thing I would say first is just awareness. Awareness in the sense that many investors look at correlation, which is a kind of a linear measure. So they look at the entire kind of time series of return, and they look at the average correlation or some type of an average co-movement among whatever pieces they have. And that number could be misleading, because when you think about tail, then you're asking really what happens in very specific situation. And if you take even kind of very simple, straightforward type of factors or signals and so on, and you look at the whole history, and then you look at specific periods, the result could be very different. So first thing is just to be aware of the deficiencies of some of the measures people use, and use the right measures and focus on tail events. And we don't have many of them. That's part of the statistical problem, that we don't have enough data, but there's a few, right? There's a few periods over the last 3-4 decades, so that would be a good start, just to look at that and understand what were the magnitudes in those cases. Now, the next thing is, okay, let's say you have that, and you're aware, what can you do about it? So I think that this view that you could estimate something very accurately is somewhat presumptuous, because you just don't have the data. And even if you do, you never know if it's going to work. If you think about the COVID crisis we had, or the COVID dynamic, very different than what we had before. It was a non-financial driven event, with some pending in the market. What were considered less risky suddenly became very risky, because it was kind of more the brick and mortar type companies, and those that were more remote, high-tech companies that were seen as more risky suddenly became less risky for a period of time at least, right? So there's things that we just don't know, we can't control, we have to acknowledge. That's a given. So I would say, first of all, is awareness. Number two is kind of modesty. We need to know. But then there is, I would say, I wouldn't stop there, right? So what we are trying to work on is trying to identify ways or measures that are ex ante as opposed to ex post. Meaning, if you think about return, those are already ex post. This reflects already trading by investors and things that happen. So if you're looking at returns in the market, you're already looking in the back mirror. You need to look at things that are happening before they filter into returns, right? Could be different dynamics in the market. The way things trade and other action by investors that may be indicating things are out of control, or things are not behaving in a way that is kind of normal, and those would be leading indicators. And when you see those, then it means that you need to kind of be much more cautious, and then you need to decide whether you want to scale down risk and so on. But again, rather than looking in the back mirror and looking at changing correlation of return, that's too late already. I mean, you got to do something else. So to me, that would be the third element here.
Yeah, please go ahead.
Maybe just to echo what you said, I think it's possible to take into account this tail dependence. And by tail dependence, to go back to basics, it's if you have two assets and they may look fairly uncorrelated in normal conditions, but somehow you happen to be in October of 08, November of 08, and then everything goes down together. And you find that in the extreme parts of the distribution, you are investing and you're trying to apply Murphy's law to portfolio construction, because when something goes wrong, everything goes wrong. Well, there are statistical tools for that, but it means that, like Eric said, you need to inject some views. because you may not have enough data points in the past. So you have to engage in the difficult exercise of scenario building and having a view. And what you said earlier about copulas, which is a heavy-handed object, can be extremely practical. Why? Because you can say, well, maybe this sector or this particular risk premia, let it be value or momentum, has fatter tail than the other. Well, how do I measure it? Maybe my risk is more asymmetric on the downside than on the upside. So you can have views that you can express relatively simply on the behavior of each of your assets in the portfolio. Maybe not stock specific, but at least country or industry specific or risk premium specific. And then put them together to have something where you have tail dependence. The problem becomes that do your risk management or portfolio construction tools, can they embed these sort of simulation views? It is possible. Maybe not. Maybe you have to build something from scratch. One of the issues, though, is that if you focus and incorporate the tail risk into your portfolio construction, is there not an additional risk that you are going to become excessively defensive? Because you start caring about the third standard deviation or the fifth standard deviation to the downside. So it becomes an agency problem as a PM.
Yeah, it's a very interesting point that you both made. You brought up the GFC and COVID, and speaking about ex ante versus ex post, we had clients trying to look for a COVID risk factor, right? Not necessarily returns, because you could not find that anywhere. So they were looking at restaurants, but more broadly, what companies are impacted by consumers. So something like restaurants is very much impacted by COVID. So they're trying to develop a risk factor to address that. It's not going to be return-based, but they're looking for additional risk factors and new data to sort of address that. So it's quite interesting exercise we ran for the client. I just want to turn to LLMs because it was a lot of discussion in these panels about LLMs. And sort of before going and to discuss LLMs in the realm of finance, I know that some of you actually use LLM for operational efficiency and operational improvements. And I wanted to hear your unique perspective, Ruben, about what your take on LLM is, maybe outside of the finance realm, of how you can potentially use it for, operational efficiency, whether it's a coding archive or just efficiency within the team. It'd be great to hear your thoughts.
So I cover capital markets out of AWS, so most of my focus is on finance, but there's obviously operational sort of efficiency use cases within finance and capital markets more generally, right? But even within AWS, we have, if you go to Amazon.com today and you read the summary of reviews, that is a summary that's being generated by a large language model that's been fine-tuned on all of our reviews just to do review summaries, right? It's very good at that. It is no good at anything else. But it's a good example of something that's direct to consumer, which in the financial industry you don't see that much. It's usually man in the middle for sort of compliance risk control purposes. But in the consumer sector, you can go direct to consumer if you have these very sort of controlled models. We also have, we have saved hundreds of millions of dollars and thousands of man hours by automatically upgrading from Java 7 to Java 11 to Java something else, whatever it is, right? So those types of tasks, again, they're sort of proven in terms of the efficiencies. Going back to finance a little bit, NASDAQ and others have released solutions around compliance and fraud management, right? So you get a positive indication of fraud or compliance breach, and then it's a manual investigatory process that usually follows, and they have deployed solutions that reduces the amount of manual time it takes to investigate a case by about 50% or so, right? So lots of use cases in that area. Going back to finance, we're seeing a lot of interest in sort of this idea of a investment analyst, right? Sort of analyst GPT, if you will. Bridgewater has been public with some of the solutions they've come out with. They have a solution for sort of the miracle research where you ask a natural language question, it gets translated to Python code, and that gets executed, and data comes back visualized, right? So it's just a much faster way of essentially democratizing access to data and analytics for analysts. Similar on the qualitative side, they have a system by which you can ask, qualitative questions and go into the data sources that Bridgewater subscribes to. And then they've also allowed you to specify a sort of chain of thought template. So not only are you asking a question about data that's somewhat proprietary to Bridgewater, but you're also able to specify the reasoning path that you want the system to take when answering that question. So it actually asks several questions of the LLM according to the reasoning path, and then sort of collates the final answer in the end so that you're able to specify how you want to think about investment problems. So those are some of the examples. I think when it comes to quant, there's not so much yet, right? It's mostly sort of fundamental use cases. The quant use cases, many of them are to do with, now it's easier to train sentiment models than before, perhaps. Now it's easier to write sort of what was traditional NLP solutions for structured data extraction from unstructured text, like web scrapers. They broke all the time. You had teams at hedge funds, 24/7, just looking at fixing the web scrapers. Now with LLMs, the logic sits in the model, and so these LLM-based web scrapers are much more resilient, right? Much more robust, because the website changes a bit or whatever the format changes, the model can figure it out, right? So that's sort of where we are. I mean, there are also some other things I can talk about that are more maybe sort of the next leading edge, but I'll give the word to someone else.
No, that's very helpful. And I know you also use LLMs for enhancing operational efficiency. Can you maybe share how you've done that and sort of the specific tasks that the LLM does?
Actually, by using a lot of Rubin's tools. What we try to do is to enhance coding efficiency. So I manage a team of developers, PMs, analysts. They're all very good at quantitative investing. However, sometimes you have new people coming in or new teams that want to be onboarded onto the infrastructure. So how do we make sure that we don't have to reinvent the wheel and train them for 6 months in order to learn all the nitty-gritty in all the code base, the repos that we have been developing over the last 10, 15 years, because there's a huge amount of information here. So what is interesting is that we've been making mistakes, and maybe we would be doing things differently, and I want to share some of that experience. Initially, what we thought was that helping people code more efficiently is very different from ingesting large amount of text. Because when you read a piece of code, it's not super digestible. And the first thing that we tried is to feed these LLMs a large amount of code without much context. And the answer, as expected, came back as complete garbage. Complete hallucinations, very difficult for Larry, the name of the coding assistant, to understand anything. So then we thought, okay, let's cut it in chunks. And that maybe resonate with some people in the earlier panel that talked about agentic LLM architecture. So what is this? It means that you have a little guy, a little agent that's very good at doing something, understanding part of the infrastructure. You have another little guy that's very good and trained at doing something else. And you got some sort of an agent on top of it that arbitrates and exchanges information in between these two in order to come up with a chain of thought, passing information between one and the other, and then coming up with the final answer. So we started with that. That didn't work very well, because then you just push the problem further. Like, how do you make sure that your top agent actually does the right thing? And then we realized something else. The quality of the answer was extremely dependent upon the sophistication and the complexity of the underlying LLM model. So whether you're using an LLM with 5 billion parameters or 11 billion parameters, however gigantic these numbers are, it makes a real difference. Having something more complex, more rich, enables us to shortcut these things. So currently what we're doing is to use some of the AWS tools like Bedrock, for instance, which enables us to pick the LLM we want, choose the embeddings we want, have no need whatsoever to calibrate the infrastructure because AWS does it, and use what we have, but provide a lot of context. So it may need adding 4 times or 6 times more information when you document something, when you write the code, which is a bit of a struggle for developers. But you give them lots of case studies, lots of questions, lots of answers, and that will help your LLM provide coordinated and good answers. And what is interesting is that it helps also the LLM then can make relations between different parts of the code. So it can use a function and then call another function within a function within a function, which is exactly what we want. So trial and error, but at the end of the day, I think it's such a fast-moving field that we need to stay on top of this.
Yeah, very interesting. And sort of enhancing the discussion to more finance, we're seeing a lot of, LLM startups approach us to get sales-side research notes, more fundamental. And I think what they're after is mostly metadata. So all the metadata behind the research reports and the textual data as well. But effectively, they're using it to train an LLM. So we're seeing a lot of that, all these startups. And effectively, they're trying to, like someone said in a previous panel, to form this research associate that can help you with financial analysis, or a morning note, like a morning summary after a morning meeting, and then maybe more targeted emails to clients who have a particular view in mind of a particular stock. So basically, taking what a typical sales side account manager does and simplifying it using an LLM, simplifying their job using an LLM. So I just wanted to maybe throw out a question. Maybe we'll start with Shafiq. What do you think LLM's role in finance is, maybe from both a fundamental and a quant perspective?
Yeah, I mean, I think there's definitely a lot of use cases. We've covered some of them already, but on the systematic side, certainly sentiment analysis is one that comes to mind, and there's been a lot of work on using LLMs for that. On the fundamental side, we've had some discussions in earlier panels today on how they can be used in the case that you described. So these LLMs are able to do some basic financial reasoning. They have a number of strengths in terms of their ability to extract information, to pull out what's relevant. And in fact, there was some research done, I believe, at the University of Chicago earlier this year that tried to see how would an LLM perform, if it was asked to do a financial analysis task. And it seemed that it actually does better directionally in terms of figuring out what earnings are going to be in the future than the average financial analyst. So, this is still early research in terms of the work that was done, but it does seem like these models have promise. Of course, one of the downsides or difficulties is that it can sometimes be hard to understand how it's coming up with those recommendations. So that is something that, work needs to be done on that.
Yeah, one of the dangers, so we've done some analysis on sort of investor days and LLMs to see if it's prudent to include sentiment on an investor day into an LLM and making a call on sentiment post an investor day. So some of the challenges is that there's a bit of a model bias in an LLM because it's trained on, it's trained using sort of current models and used on historical data. And some of the other challenges is that the data it pulls could be somewhat have a look-ahead bias because you could even guardrail the dates, but we don't necessarily know if the LLM is going out in the future and doing the analysis. So there's some inherent risks, I think, with these LLMs. And maybe, Samira, you can sort of talk about how you can sort of deal with these model or, look-ahead bias risks, maybe with LLMs or even broader strategies.
So for us as well, we have a couple of applications that we have applied LLM and we have faced some of these biases, and maybe I can share some of the sentiment analysis is one of the things we want to look at the market short term, understand what are the pitfalls, what are the market dislocations you want to capitalize on, and we have built an LLM system that works very effectively in capturing. We receive a lot of these sell-side research analysts, and 20, 30 of them, each 50, 100 pages, different indicators, and you have this future positioning data that they have their own problems. So what we've done, we've applied LLM to basically provide us the sentiments, the final scoring of these sell side. We look at biases, I guess. It happens in traditional machine learning style as well. With LLMs, it's like the back testing of data is not really practical. It's not feasible when there is a data involved. So for us, before allocating any risk to a model, LLM-based model, we try to incubate the model for a longer period of time, make sure that it really performs out of sample, then allocate risk to that. That's one way of dealing with it. There is another example maybe I can share related to a project. We wanted to extract the tone of central bank, and we were facing some difficulties with ChatGPT. It was mixing tone with sentiments, and we had to fine-tune the internal LLMs on some of the domain expert data that were labeled by our own capital markets. So in that case, to fine-tune again, you can face this problem that the models are basically trained based on data sets that you don't have transparency. What are those data sets? And those data sets can come with different variation and correlation structure that are not serving your purpose, the application that you're using. So in that case, you have to basically bring in, fine-tune them with your own sort of either human-based data or other methods. So that can help.
Very interesting. Go ahead. Arik, go ahead.
I like to play a little bit of a devil's advocate here. So I think if you look at, kind of historically, the finance industry and there's those type of topics, I want to call them trends, but that people get excited about, right? And there's every so often there is another emergence of another thing. And we need to be cautioned. There is a lot of, I think, benefit and promise, but like anything, there's also some downside or some issue that people need to be aware of. Right? So the first, I think, when you think about LLM is that they do have deficiencies, right? I'm not an expert on NLM by any stretch, but just from reading, sometimes they make mistakes. Sometimes they were found to have various type of biases. I think the problem is that when you, as an investor, you're being presented some research or a new idea or strategy, one of the first questions that investors ask is kind of what should I be aware of? What's the risk here? When it may not work, right? When you have a signal or a strategy or any one of the things we spoke a little bit about before, it's often you can at least point to when something may not be working as well, right? In what state of the world, what may be an issue. What to do about it may be more difficult, but at least you know. With this tool, it's very difficult, right? It's a complete black box. So it may work well or not work. There could be, again, various problems, deficiencies. You just haven't found them yet. So that's one. Number two, it may be very good at aggregating data, but inferring on a kind of a one-off is something else. And what I mean by that is the following. If you think about getting a kind of a quick read into the mood in in newspapers about a certain topic, you want to aggregate a lot of articles about something, that obviously would be a great candidate for this, efficiency and scale and so on. If you want to understand on average what was the verbiage by company executive after earning calls, you just want to aggregate over many companies, that's great. Now let's go to one a one-off case. So there is a company. You have maybe the Q&A session and the executive are up there and they're answering questions. And you want to use this to try to glean the sentiment and see if there's anything there that didn't get reflected in the earning reports. So not only, of course, it's more difficult because it's a one-off as opposed to averaging, but I can tell you that we had requests from companies to educate their executive on how to talk in those instances in order to essentially be interpreted the way they want to be interpreted, right? So like anything, it's a tool, and this tool, when it's applied, again, on average, or when it's applied to text that is not being manipulated,
It's being gamed.
right? But you can game it. So that's a risk you need to be aware of. So in a one-off, it can be gamed. Certainly, if you so there's those issues as well. We talked about crowding before. If kind of the whole industry starts converging into using this, then you would expect a lot of similar outcomes among investors, right? So again, you'll have we may call it crowding or not, but you're going to be using the same inputs and likely making the same decision, and we're going to see even more gyration in the market as a result of that. So yeah, you'll be processing more information more quickly, but you'll be making ultimately the same decision, and the market will be even less efficient, to Cliff's point. So I think those are all things that we need to keep in mind. Again, there is a big difference between operational efficiency and the ability to be more productive, and the substitution of, I think, the kind of the decision making with this tool.
Maybe just to comment on that. I mean, I totally agree with that. I do think, though, that there's sort of a crossover between the two, right? In being more productive, being able to use more data sources, more alternative data sources, more textual data, being able to read the news as it comes in, like on the Bloomberg screen when it scrolls down the screen, you can't even read it, right? And you certainly can't absorb the content of the articles, whereas now potentially you can. We actually have customers that are working on solutions whereby throughout the day you can look at topics that are being populated, and the topic may grow, it may shrink, and it's essentially cluster analysis of the embeddings of the vectors in all these news articles, right, that are coming through. So fast you can't read them, but now you can read them by way of reading the summaries of each cluster and then drill down the articles if you want. And you could potentially automate that fully, right? You could have news and clusters of information with associated companies, and you could have sentiment of one cluster or one topic that's positive, sentiment of another one that's negative, and the companies associated therewith. And now you could automate the trading of positive and sentiment baskets of stocks associated with those topics. So, those things are going to be, they're not going to be done by humans, right? It's just there's too much information. It would take too long. There's only one way to do it. So but I think we're sort of saying the same thing in the sense, I think there's efficiency at some point can lead to sort of new investment strategies and being able to take advantage of data better than, without those efficiencies. And so it becomes sort of a net additive strategy, if you will.
You're saying that efficiencies can lead to innovation. We're out of time. Shafiq, any last words do you wanted to add?
No, I mean, I just wanted to, your question about event bias, I mean, the gold standard would be to have the large language models created in a way where you have a rolling window. So you have training and then test moving forward. Of course, that's not really computationally feasible. And I mean, you could ask, if you're using a prompt, you could tell a large language model not to use data that's in the future, but it often doesn't listen to that. So it is a challenging problem, and I think until we're able to produce these models on that rolling basis, it'll be hard to really deal with that event bias completely.
We're out of time, and I wanted to thank all of our esteemed panelists for participating in this panel discussion with myself, as well as the organizers for organizing the panel. Thank you very much.